All right, the real key that we found to automated trading is using futures. Futures makes it possible to automate really smooth the process of making sure the orders go from our charts to our broker. And futures is something we're going to talk about now, but also talk about the middle person, which is a system we call Traders Post. And we'll go right into it.
Now, I also want to make sure that our audience knows, part of why our program works is because of the automation.
Yes.
So it kind of like feeds on itself.
Yep.
Right. The automation, warrants us to have to work with futures, but because we're working with futures, we really need it to be an automated system for us to get the returns that we need to get because of pulling out the human element here.
Yes, absolutely.
That's the big key.
Futures has the benefit of really being able to trade frequently without the settlement problems. You don't need the margin like you would typically on a stock account or equity account. It has some tax advantages as well. You can trade it in a IRA account, and it's awesome. So anyway, over the last 24 years, we as the brothers, we've been working hard. We've been saving our money, but we've been frustrated, right?
We're just doing day jobs.
Just doing day jobs.
Right. We're not independently wealthy. We're just plucking away.
We've loved the markets, and we realize whenever we try to make money figuring out the trades, day trading, we've tried so many different strategies. It never worked, especially when we're doing the day trading. And, we just never figured it out.
And the reason why it didn't work is because our human emotions were involved.
Yeah.
Not only do we not know as much as we know now, but our human emotions were involved.
So we
keep thinking.
Yeah. So a lot of kudos and props to those who actually day to day and day out have been consistent and day trading and making a profit. You're about you're 1%. You're the 1% of people who've actually been successful as traders. We're like the rest, the 99%. We find that in swing trading, we can avoid over the last 24 years. Here's what the S&P 500 looks like. These massive drawdowns. This is what we try to avoid. This is the whole goal. We want to have better returns than this is going to be offering. And here's what we found. The NASDAQ 100. Do you see this blue line right here? This is the buy and hold. This is if you held the NASDAQ back in 2000, it would have seen an 85% drawdown, which means your money would have lost 85%. You would have regained that. But the green line here is our strategy, which is through TradingView. So this strategy has outperformed the buy and hold, which is fantastic, and we use futures to get there.
So not only are we limiting our drawdowns, we're also having a better quality of life because we're not going through that mental go home and kick the dog syndrome because we just lost a lot of money and our wife told us don't do that.
Exactly. All right. So like I said, it's a swing trading. It keeps us in the market between 1 to 3 days. It's not scalping. Sometimes we're in for a week. That's a long trade. But sometimes we're out for a long time. If it's in a downward trend, like during COVID, we were out for many weeks. But, so anyway, the swing trading is what we found is the best way for us to make consistent returns. And if you like what we're doing here, be sure to subscribe and comment and like the video. Hit that notification because, we'll always keep you posted. And we are not financial advisors. That we're using our money. We use our skill to do the coding, create the strategy, and we're presenting it to you and sharing it with you. So that's what we're doing here. We are not your financial advisor. Now, so the stock market is average 10% a year. For the last 100 years, you can kind of count on it. But again, it comes with all those drawdowns. Every 10 years, it's going to kick you in the pants. And then,
I always said, buy and hold, or it's like buy and get old. It does. It literally wears you out.
So our goal is to make 20% a year. That's our really going to be, I think, our long-term goal, 20% a year. That's our goal. And our second goal is to reduce those drawdowns so we don't see those 30 to 50% drawdowns every 10 years. We use that just as you see here. We've accomplished that through the S&P 500 and the NASDAQ. We use the futures trading to do it. The futures, again, like I was saying before, you can set it up with the standard non-retirement accounts, IRA accounts, SEP IRA, and business and trust accounts. Let's describe how this microfutures, at least the microfutures account sizing would look like. And why are we showing the plan sizes we're showing 34,000 and 204,000 right here. Now, why are we suggesting these balances here. And I was telling my brother Tom, because it can get really complicated. You'll notice this plan size here is for 2 micro futures contracts. The second one here is for 4, then 6, then 8, then 10, then 12. And when it says suggested account size, this is just what we're suggesting.
Right. Yeah. This isn't like a formal, big box bank saying, hey, you need to have at least 999. No,
yeah.
No, these are not subjective. They're relative numbers based upon how the market does.
Yeah. And let's say 24 years ago, you put in $34,000. Okay. You traded 2 contracts on our one strategy. And you would have seen, just based on the back test of TradingView, a 22% return, an IRR, annually. That's the annual return, 22%. And you would have seen a drawdown of 28%, a max drawdown, basically the max drawdown from the peak to the valley. And that was really about the time of the Great Recession. When the S&P 500 was going down 54%, this strategy was going down 28. But again, 22%. The point is that if you put in 204,000 and ran these 12 micro futures through 6 strategies, you would have seen a 23% annual return with a 17% max drawdown. Okay. So hopefully that's clear, because it's really important how the futures works. These are not required amounts, but suggested because there's margin involved.
Yep. Now, the one thing I would like to hit on is, why is it not 24,000? Why is it 34? Why is it not 14,000?
Because that number is based off of what I had to dial in because if I put it 24, for example, if I put $17,000 here, these numbers would be double. I would have 20, basically, essentially 44% returns annually and a 50 or close to 60% drawdown. That would be too much risk for me. So I think we need to have more. That ratio is important. You can, again, your broker will let you trade will let you trade with almost basically $4,000 in the bank. Will let you trade 2 micro futures contracts, but that's not our intention. Intention is not to do that.
Got it. So yeah, we are keeping pretty even across all those different micro futures, plan options, about 22 to 23% IRR. But look at that max drawdown. It goes from 28, all the way down to 17. That's a big move.
Yeah, that keeps our drawdown low, is at those levels. We take the TradingView strategy. It has the code. It has a JSON code in it, and it sends it through an alert that goes to Traders Post. Okay, so this is what it looks like. This is how we get the automation. It goes from TradingView, then to Traders Post. Traders Post is this middleman, and what they do is they convert this JSON code, which I'm showing you here, right here. This is the JSON code. It takes it and it sends it to the broker, which currently right now, this system works well with Tradovate and TradeStation. Traders Post is that middleman that connects the two. TradingView, it connects TradingView and the broker.
A whole lot of trading in there.
Yeah,
but again, they're not affiliated.
Yeah.
They just happen to have similar names.
So here's an example. I took a trade recently from Traders Post. This is what the order looks like going through Traders Post, and it happens within a split second when that alert goes out. It is then triggered at TradeStation, and it's all recorded in the Traders Post. Whenever it activates. Again, what is Traders Post? It's a trading platform that automates your TradingView strategies to brokers like TradeStation and Tradovate. Those are huge brokers. TradeStation's been around since the 80s. And they have their own trading platform. You can do your own strategies with them. But I find it very cumbersome to use their charting software. Now, again, I just like the ease of use that TradingView has. And so we use Traders Post to get our strategy to work with TradeStation. Okay. So it takes that code, converts it to the cell. This is what a Traders Post dashboard looks like. You can have your live brokers up here that are attached. You have your paper brokers, like your demo accounts. You can set up your strategy subscriptions, and there's webhooks. And with the Brothers Automated Trading, what we're doing is we're offering you a way to copy trade using our signals through Traders Post. So what you have to do if you want to participate in this strategy is you're going to see in the description a link and basically a way to purchase the subscription for the copy trade. You can, for those who are advanced, can actually purchase the Trading View strategy. So be sure to take a look at those options below, and we'll be back with another video.
All right.
Here very soon.
Thanks, guys.